today, think of it as like Forex 101, you know?
Yeah, like a beginner's guide to the biggest financial market on the planet.
Exactly. And our goal today is to, well, kind of figure out the basics, right? Like, what is Forex trading? Why would anyone want to do it? And how does this whole thing even work?
Sounds like a plan. And when you say biggest market, we're not exaggerating. Forex is larger than the stock market and the bond market combined.
Seriously. Wow. I knew it was big, but
Yep, we're talking trillions of dollars changing hands every single day.
okay. So the source starts off pretty basic. It says Forex, in simple terms, is currency trading. So, buying and selling different currencies. But then it jumps into this whole thing about how much bigger it is than any other market. How is that even possible?
Well, you got to think about it this way. Practically every transaction that crosses international borders involves exchanging currencies, right?
Yeah, I guess.
So every time a business imports or exports goods, every time someone travels abroad, every time someone invests overseas, it all adds up.
That makes sense. But why would someone choose Forex trading over, say, investing in stocks?
Okay, so there are actually a bunch of advantages to Forex trading. First off, it's open 245. It follows the sun across all the different financial centers around the world.
So you can trade anytime.
Pretty much, yeah, anytime, anywhere. And another thing, unlike regular investing where you're kind of betting on prices going up, with Forex, you can profit whether a currency is rising or falling.
So it's like double the opportunity.
Exactly.
That is interesting. But I've heard about this thing called leverage in Forex trading. People say it can be risky.
Ah, yeah. Leverage, it's kind of a double-edged sword. See, it lets you control a much bigger position than what you actually invest.
Can you give an example?
Sure. So imagine you have a leverage ratio of, let's say, 1.100. That means you could control a $10,000 position with just $100 of your own money.
Wait, seriously. That's,
Powerful, right?
yeah, but also pretty risky.
Exactly. That's the catch with leverage. It magnifies your profits, but it also magnifies your losses. If the market moves against you, you could lose more than you initially put in.
So responsibility is key.
Absolutely. You have to understand how leverage works and use it very carefully.
Okay, that makes sense. So how does the Forex market actually work? Is there like some huge trading floor somewhere?
Nope, not really. Unlike the stock market, which has those physical exchanges, Forex is mostly decentralized. Most transactions happen over the counter.
Or is it counting?
Yeah, which means they happen directly between participants. It's all facilitated through a network of banks and financial institutions.
So it's more like a giant network.
Yeah,
I mean,
exactly. A global web of interconnected players. At the top, you have these major banks, the big players. They provide liquidity and set the bid-ask spread for currency pairs. Then you have hedge funds, corporations, and even individual traders like us. It's a global market.
all right, so let's talk about currencies themselves. The source mentions they're always traded in pairs. What does that actually mean?
Okay, think of it like a seesaw. You're always comparing the value of one currency against another. Take the URSD pair, for example.
Euro and US dollar.
Right. If the quote is, say, 1.25, it means 1 euro equals 1.25 US dollars.
Okay, so if I think the euro will be worth more than the dollar, I'd buy the USD pair.
Yep. And if you think the euro will weaken, you'd sell.
Got it.
Oh, and here's a fun fact. The US dollar is involved in like 86% of all Forex transactions.
Really? Wow.
Yeah, it's the most traded currency by far.
So for beginners, is it better to just stick to pairs that include the US dollar?
The USD is often recommended for newbies. It's the most traded and usually has the lowest spreads, which means lower transaction costs for you.
That makes sense.
But ultimately, the pair you choose depends on, well, your trading strategy and what's happening in the global economy.
Speaking of strategies, the source mentioned something called technical analysis. Can you explain what that is?
Sure. Technical analysis is basically studying charts and price patterns to try to, predict what the market will do next.
Ah, so it's like trying to read the market's mind.
Kind of.
So lots of charts and graphs and things.
Yeah, it can seem intimidating at first, but the key is to learn how to interpret those charts. The source talks about three main types: line charts, bar charts, and candlestick charts.
Candlestick charts. Those sound kind of cool.
They are pretty cool. They're actually really popular among Forex traders because they show you a lot of information about price action and how traders are feeling.
Interesting. How do they actually work?
So each candlestick represents a certain period, like an hour or a day. It shows you the opening price, the closing price, the high and the low for that period.
Okay, I can picture that.
And the shape and color of the candlestick tell you something too. For instance, A green candlestick with a long body suggests that buyers were really strong during that period.
Ah, so green is good.
Generally, yeah. And then a red candlestick with a long upper shadow. That might indicate sellers were strong, but buyers eventually took over.
So it's like a battle between buyers and sellers,
Exactly.
and you can see who's winning.
Yep. By analyzing those candlestick patterns, traders can try to figure out where the market might be heading next.
That makes sense. So are there certain candlestick patterns that are good for beginners to learn?
Oh, for sure. There are a few common ones like the hammer, the engulfing pattern, and the doji. They're relatively easy to spot and can give you hints about potential trend reversals.
Okay, I'll have to look those up. But before we go any further, I got to admit, I'm starting to feel a bit overwhelmed with all this information. Is it even possible for, a regular person to grasp all this and become a successful trader?
Definitely. It just takes time and practice. You don't need to become an expert overnight. Just focus on building a solid foundation and maybe start with a demo account to get some experience.
Okay, that's reassuring. All right, I think that's a good place to pause for now. We've covered a lot, but there's still more to explore. All right, welcome back to our Forex deep dive. So last time we were talking about candlestick patterns, right? And how they can help us kind of decode what the market's doing.
Yeah, they really are like a language of their own.
They are. It's amazing how much you can learn just from looking at those little candlesticks.
Definitely. But, candlestick patterns, they're just one piece of the puzzle when it comes to technical analysis.
Right.
Today, let's talk about something called oscillator divergences.
Okay, oscillator divergences.
Yeah.
Those sound a little complicated.
Not really. Think of it this way. Imagine a car speeding down the highway, right?
Okay.
The speedometer, that's like your oscillator. It shows you how fast the market is moving, the momentum. Sometimes, though, you might see the speedometer saying the car is accelerating, but the road signs say something different. That's a divergence.
So it's like the oscillator saying one thing,
Yeah.
but the actual price action is doing something else.
Exactly. It's a warning sign that maybe the current trend is running out of steam.
Okay, I'm starting to get the picture. How do you actually spot these divergences on a chart?
Well, you got to look for situations where the price of a currency pair is making higher highs, but the oscillator is making lower highs. Like, let's say you're looking at the RSI, the Relative Strength Index.
Right, the RSI.
If the price is going up, but the RSI is going down, that's a bearish divergence. Could mean the upward momentum is weakening.
So it's like the oscillator saying, hey, things might not be as good as they seem.
Exactly. And the opposite is true, too. If the price is making lower lows, but the RSI is making higher lows, that's a bullish divergence. Could mean a reversal to the upside is coming.
Interesting. So why is the RSI so popular for spotting these divergences?
Well, the RSI is all about measuring the strength of price movements. It tells you whether a currency is overbought or oversold.
Overbought or oversold?
Yeah, so it basically ranges from 0 to 100. Above 70 is usually considered overbought. Below 30 is oversold.
Okay, so traders use the RSI along with the price action to try and anticipate changes in the trend.
Yep. Divergences don't happen all the time, but when they do, they can be pretty strong signals, especially when you see other indicators and patterns confirming them.
Got it. Now, earlier we briefly talked about fundamental analysis. How is that different from technical analysis?
All right, so think of it like this. Technical analysis is like reading a company's stock chart to see where the price has been and maybe where it's going.
Right.
Fundamental analysis is more like digging into the company's financials, their business model, to figure out how healthy the company actually is.
So technical is charts and patterns. Fundamental is all about the underlying economic and political stuff driving currency values.
Exactly. Stuff like interest rate differentials, economic growth, political stability. Those things can have a huge impact on exchange rates.
The source mentions that there are some key economic indicators that Forex traders should pay attention to. What are some of the most important ones?
Well, inflation is a big one. If a country's inflation rate is higher than expected, it can make their currency weaker.
Makes sense. What about GDP growth?
GDP growth, that's a major indicator of a country's economic health. Strong GDP growth usually attracts foreign investment, which can push the currency higher.
So a strong economy usually means a stronger currency.
Most of the time, yeah, but it's not always that simple. You also have things like geopolitical events, central bank policies, even just general market sentiment can influence currency values.
Speaking of geopolitical events,
Yeah,
do those have a big impact on the Forex market?
huge impact. Things like elections, wars, natural disasters, those can cause a lot of volatility.
Volatility meaning.
Meaning the prices can fluctuate a lot,
Yeah.
go up and down quickly. For example, during times of political uncertainty, investors often move their money to safe haven currencies like the US dollar or the Japanese yen.
Ah, so those currencies tend to go up in value during those times.
Yep, exactly.
Wow. It's fascinating to see how interconnected the global economy is and how different events can impact the market.
It really is. That's why it's crucial for Forex traders to stay on top of global events and try to anticipate how they might affect currency values.
Right. Now, the source also mentioned a connection between commodities and currencies. Can you explain that a little bit?
Sure. So countries that depend heavily on exporting commodities like oil or gold often see their currencies move in the same direction as commodity prices.
So, if the price of oil goes up, the currency of an oil exporting country would likely strengthen.
Yep. Because higher oil prices mean more revenue for the country, and that can increase demand for their currency.
Okay, that makes sense. This is all super interesting, but before we get too carried away with all these external factors, I think we need to circle back to something we talked about earlier, risk management.
Absolutely. You can be the best at technical and fundamental analysis, but if you don't manage your risk properly, you're going to have a tough time in Forex.
Right, the source really emphasizes setting a maximum account risk per trade, ideally 1% or less. Why is that so important?
Well, think about it. If you risk too much on one trade and it goes against you, you could wipe out a big chunk of your trading capital.
Yeah, that wouldn't be good. So by limiting your risk, you're basically protecting yourself from blowing up your account.
Exactly. It helps you stay in the game even if you have a few losing trades, which, happens to everyone.
Right, it's not always going to be smooth sailing.
Yeah.
So how do you actually figure out how much to risk on a trade? I remember the source talked about pip risk and pip value, but that went kind of over my head.
Okay, let's break it down. A pip is basically the smallest price movement a currency pair can make. Pip risk is how many pips you're willing to lose on a trade, and pip value is how much money each pip is worth.
Okay.
So let's say you have a $10,000 account, and you're only willing to risk 1% on each trade, which is $100. First, you set your stop loss level, which is basically the price where you'll automatically exit the trade if it goes against you. Let's say your stop loss is 50 pips away from your entry price.
So my pip risk is 50 pips.
Right. Now, you got to figure out the pip value for the currency pair you're trading. That can vary depending on the pair and your account currency. Let's assume the pip value for UESD is $10 per pip.
So 50 pips times $10, that means my total potential loss would be $500.
Yeah, but remember, you only want to risk $100. To calculate your position size, you divide your maximum risk by your total pip risk. So $100 divided by $500, which is 0.2.
Meaning I should only trade zero point 0.2 lots.
Exactly. That way, even if you hit your stop loss, you only lose $100.
Wow, this is actually starting to make sense. It's like a combination of math and discipline.
It is. You got to understand the concepts and then have the discipline to stick to your plan even when things get emotional.
Right, because I imagine it can get pretty emotional when you're watching your trades and seeing your money on the line.
Oh, definitely. It's one of the biggest challenges in Forex trading.
Well, this deep dive has been so informative. I can't wait to hear more in part 3, especially about the psychological side of trading. I think that's something that can really make or break a trader. All right, welcome back to our Forex deep dive. We've covered a lot of ground already, from charts and indicators to all that stuff about economic factors and risk management.
Yeah, we've really gotten into the nitty-gritty.
We have, but there's one crucial element we haven't really touched on yet.
Oh, you mean the psychology of trading?
Exactly, the mental game. Because, you can have all the technical and fundamental knowledge in the world.
Right.
But if your head's not in the right place,
You're going to struggle.
yeah, you're going to struggle big time. The source talks about how emotions like fear and greed, they can really mess up even the best trading strategies. Have you experienced that firsthand?
Oh, countless times, especially early on in my trading career. I remember this one time I was on a winning streak, making good profits. Yeah, it was great at first, but then I got a little carried away. I started feeling overconfident, like I could do no wrong.
Yeah. The danger zone.
Yeah, exactly. I started taking bigger and bigger risks, ignoring my own risk management rules.
Oh, no.
Yeah, it wasn't pretty. The market turned against me, and I ended up losing all my profits and then some. It was a tough lesson to learn.
Ouch. But I guess a valuable one in the long run.
Definitely. It taught me the importance of emotional discipline, keeping a cool head, even when things are going crazy.
Right. So how did you start to overcome those emotional pitfalls? The source mentioned keeping a trading journal. Did you find that helpful?
Super helpful. A trading journal, it's like a mirror that reflects your trading habits. You write down every trade, your
Mhm.
entry point, your exit point, why you took the trade, how you were feeling at the time.
Interesting.
And then you can start to see patterns like, are you prone to overtrading? Do you chase losses? Do you cut your winners short?
So it's not just about analyzing the market, it's about analyzing yourself too.
Exactly. You got to understand your own biases and tendencies, your own psychological patterns.
Right.
And once you understand those, then you can come up with strategies to counteract them.
So if you notice that I don't know, you tend to get impatient and exit trades too early.
Yeah.
You could set a rule for yourself like, okay, I'm not going to exit a trade until I see a specific signal on my chart.
Exactly. It's about creating rules and then having the discipline to stick to them, even when your emotions are telling you to do something else.
Right. It's like a diet. You can make healthy choices when you're feeling motivated, but when those cravings hit,
It's tough.
yeah, it's tough to resist. So, okay, we've got our technical tools, our fundamental analysis, our risk management plan, and now our emotional discipline. Anything else we need to think about before we jump into Forex trading?
Well, you got to choose the right trading system, the right platform for you.
Right. The source talked about a few different options like using a broker or direct dealing or matching systems.
Yep, there are a few different ways to go about it.
And it mentioned that in the past, most Forex trading was done over the phone with brokers, but now it's mostly electronic.
Yeah, the internet has really changed the game. It's made Forex trading much more accessible.
So, what are the pros and cons of using a broker versus, say, a matching system?
Well, brokers, they can offer you personalized service, research tools, educational resources, things like that. And they can also provide leverage.
Right, which can be both good and bad, like we talked about earlier.
Exactly. And matching systems, those are basically electronic platforms that connect buyers and sellers automatically. They're anonymous, fast, and usually have lower transaction costs.
So it sounds like there's no one-size-fits-all solution. You got to figure out what works best for you.
Exactly. Do your research, try out different platforms, and choose the one that aligns with your trading style and your risk tolerance.
Makes sense. Wow, we've covered a ton of information in this Forex deep dive. I feel like I've learned so much.
Me too. It's been a great journey.
It has. Any final words of wisdom for our listeners before we wrap things up?
I'd say remember that Forex trading is a marathon, not a sprint. Be patient, be disciplined, and never stop learning.
And don't be afraid to make mistakes. Everyone makes mistakes, especially when they're starting out. The important thing is to learn from those mistakes and keep improving.
Couldn't have said it better myself.
Well, that's all the time we have for today's deep dive, but as always, I want to leave you with something to think about. We talked about how commodity prices can affect currency values. So here's a